Today's video, all about backtesting. So, backtesting is a way of becoming a profitable trader much faster without putting money on the line and wasting a load of it. It's something I've done for years now, and whenever I trade or develop a new strategy, it's something I'll always do. So what it is, let's pick a market, let's pick the S&P 500 index, and for a certain strategy we're going to have rules. So we have rules to enter, rules to exit, whether it would be a profit, and rules for a stop loss, so to take a loss. So let's keep it ever so simple, and let's take the S&P 500 and say we're going to enter a trade when the price closes at a 7-day low. Stop loss 20%, keeping it ever so simple. Profit taking, closing at a 7-day high. So we've got our rules, so we know when we're going to exit, enter, when we're going to exit. So now what we can do, we can go back, we can pull up a chart, or a daily chart of the S&P 500. This will work on any time frame, whether it's daily, weekly, or shorter term, hourly, 5 minute. So we pull up a chart and we can look back and we can manually look at every trading signal that we would have had we been trading real time. And then what we can do, now I've created lots of spreadsheets, just put the data, doesn't have to be anything too technical, put the data in, and what we can do is we can log each trade as they come, taking every single trade over a given period. And at the end of that we can say, oh, at the end of that year we were profitable, we weren't profitable, or at the end of 3 years, or at the end of 6 months, and we really get a feel of how, if we would trade this strategy in real time, and how it would work. So when I backtest daily, weekly strategies, I like to backtest them over many markets, because there's three sorts of main markets. You can have up markets, bullish markets. You can have markets where pretty much goes sideways, and then of course you can have bearish markets where it goes down. So I like to backtest over all of those scenarios, if you like. I generally backtest probably back to about 2002. 2002, the market's ever so slightly changed. Electronic trading become much bigger, so especially the S&P 500, you weren't getting the overnight gaps, etc. So the more data, the better, obviously. So once we got this data, we can plot equity curves, we can see, important one is maximum drawdown. You're always going to get a period where the strategy isn't performing very well, you're going to be losing money. We can see where these drawdowns will occur, how much they will be, and what it will do. If we know the drawdowns that we've seen in the past, like if we've seen a 10% drawdown in the past, and then we decide to start trading in real time, and we would get into a drawdown, and let's say we're 6-7% in drawdown, we might give up and think, oh no, this is a losing strategy. But had we backtested it, had we know the characteristics of the strategy, we could say, actually, that's it, that's totally in line with how this strategy performs, and it will give us the confidence to continue trading that strategy and then become profitable. So yeah, essentially we can say whether a strategy is going to be profitable or isn't going to be profitable. If it's not going to be profitable, backtesting, I wouldn't even bother trading it in real time. If it is profitable, clearly is profitable, and we've got a decent edge, then I can go on, start trading it in real time, but with small amounts, because although it is profitable in the past, it is no indication of the future, but there is a good chance. But I'll always start off small, get the feel of it. If it starts working, introduce more money to it. And then, so some people, that's what they would call sort of forward testing. So test it in real time. But for me, I generally trade strategies coming off a daily time frame. And if I was forward testing, it could take years. It could take wasted money and years. Okay, if you're forward testing, if you're taking trades off of 5-minute charts, then forward testing is okay, because over a period of a week you'd rack up quite a lot of trades. So that's back testing. What we can also do, that's a manual way of doing it. That's generally the way I do it. You get a feel of how the trades pan out, a feel of, like I say, the drawdowns, the peaks. But there are computerized, very fast ways of doing it. You can pump all your data into programs, and they can automatically backtest for you. It's not something that I've done because, like I say, you don't get the feel of it, but it is something I am going to consider in the future, because I'm always introducing new strategies. I love to see how they perform in the past, and then obviously trade them in the future. So that's backtesting. I encourage you to do it. Obviously, like I say, it only works on a rule-based strategy where you've got predefined entries and exits, stop loss, profit taking. If you're trading from a more discretional point of view, it's not going to work, because it's all very well you can say, oh yeah, I would have taken that trade in the past, or I would have taken that one, knowing what would have happened. But in the future, it's very, very different. Rule-based strategy is much easier to trade in the future if you're nice and disciplined. So that's the one on backtesting. I hope you enjoyed that. I do encourage you to try it yourself, and if you want to learn more, subscribe to my YouTube channel and head over to my blog at thetransparenttrader.com, and I will see you on the next video.